process. So I'm just going to close the screen for a second. If you have any questions, I want to make this as interactive as possible. So obviously just ask any questions in the chat and I'll do my best to answer as we're going through it. Just note that some of the things are actually covered in the presentation as well. So really the first thing I want to highlight is that the outcomes for this session is I want everyone to understand. So obviously, so Damon mentioned the technical side. I want to understand, I want you to sort of walk away from this webinar with an understanding of the emotions. Ideally have sort of improved confidence around the process and provide some basic tips how you can save time, save money and improve efficiency. And that at the end, I'll sort of be talking about CRIISP, which is a platform that we've built specifically for capital raising. And then also I'll be going through some of the mistakes that founders typically make that we see and how to avoid them on the process side. So as context, you know, I'm also the founder of Wholesale Investor. I've been through several different capital raises myself, from having Investec as an institutional bank, become a shareholder, also BMY Group through their VC fund, also become a shareholder. And I've also got private high net worth shareholders now from 5, 6 different countries. So you said from myself, and also we work with, you know, hundreds of companies each year that are raising money to give you context. Wholesale Investor itself, we built a database of just over 29,000 investors, both private, professional, and also international. And that's sort of important to note, you know, because I say we deal with a range of people in this area. Okay, so topics we'll be going through: the real cost of raising money, the attitude for success and failure, the 7 steps that we typically encourage, some tips on how you can actually improve your conversion rate, the investor psychological factor, and then we'll finish off with the common mistakes. So first, I always like to kick off with what are some of the myths that people typically have around the area of raising money. And the number one myth that I'd say as a starting point is that it takes 2 to 3 months to actually raise money. So one of the frustrations we have is that, you know, we typically deal with a lot of sort of advisors and investors, and I know that they make us as founders feel like there's something wrong with our company if we haven't raised money within that sort of 2 to 3 month period. The reality is fewer than 5% of companies are actually able to achieve that. And when I do this in a sort of workshop environment where sort of typically got about 100 people, it's interesting to note that, you know, literally there's only either 1 or 2 people that put up their hands, or sometimes none. When I ask the question, who here has been able to finish a capital raising from start to finish in 2 to 3 months, right? So just want to give you some context as to how unrealistic that is. The next one is that people feel like companies and advisors are actually using analytics in their raise, right? And I'll go through the process sort of throughout this presentation. And then the last one is that VCs are the main investors. It's amazing how many people think that this is still the case. Now, whilst obviously VCs are very prominent in Australia, the reality is their coverage in the media is very different to what is actually happening in the ecosystem, where said they invest in less than 1 in 100 companies. So the question I always have for people is, well, who do you think is actually investing into all these companies if VCs are investing into less than 1 in 100? The best stat I heard was actually 1 in 818, right? So they looked at 818 deals and invested into 1. So that's why we sort of focus around the high net worth and family offices areas. And I'll give you some stats during this presentation, which will sort of, you know, give you some understanding about who's investing and what they're investing into. Okay, so what is the process that we as founders go through? And I like to sort of kick off with this because I think it's really important. Now, when we actually typically start off with a capital raise, us as founders, we're naturally optimistic. So the first part is we actually start off is we're quite overconfident, right? Because we've been talking about what we're doing, we've been brainstorming, we've got plans, you know, we've either hit some milestones or whatever it may be, right? We are naturally overconfident about what we're actually doing. And then what happens is you go out, you start to speak to a few investors and you start to experience some rejection. As you start to experience this rejection, then typically what you do is you start to have some doubt, right? Now, the reason why I highlight this is that basically this is just a normal process. I want you guys to understand that this is what you're going to go through so that when you do go through it, you realize it's just part of the process, right? So when you start to experience that doubt and you're also being rejected in your offer, you start to question your business model, your technology, you start to question so many different things, especially if you have a few rejections back to back. And then what happens if you're getting these rejections and you're also looking at your bank account going down, right? Then also fear starts to come into place. And what you typically find is in those deep, dark moments when you're most scared, that all of a sudden you have, you're going out, you're pitching, you're putting on your brave front and all that sort of stuff, which is what we have to do as founders. And then all of a sudden you have an investor come through. And when an investor comes through, we go back to feeling bulletproof. This is the emotional cycle that we typically go through in a capital raising. Now, why I love doing these workshops is because I'm not here saying, basically presenting this saying, I'm so amazing at raising money. I'm presenting this to you as these are all the mistakes that I've made. These are all the emotions I've experienced. These are my rejections. And this is what I've done. And this is the process that I've learned. And also that we've learned from our clients as well. So I hope you understand that as a context of where I'm coming through. And one of the things that people don't like to talk about is rejection. So rejection is a very, very common part of raising money. In fact, you should definitely expect it because it's going to happen. And so what I do to typically start off is I like to highlight my rejections. And the first one I'll kick off with is your valuation is too high. I always kick off with that because that is pretty much one of the most common rejections that people get in raising money and that we have seen through our ecosystem. There's always that sort of discrepancy between how we value our business and how an investor could potentially value our business. The next one is probably the most frustrating for most founders is when you're dealing with an investor and then all of a sudden they just go silent on you and they just stop replying to you. They don't return your calls, they don't return your emails, and they don't reply to your messages. This is just another way of rejection. And if you think it doesn't happen to me, if you think it doesn't happen to all the successful companies you're reading about, you are absolutely mistaken. The next one is I prefer to go in at Series A or earlier. So these are my personal rejections. Some of you, if you're earlier in the cycle, people may be saying to you, oh, come back to me when you've done this, this, and this, right? So, different investors have different stages that they like to invest into. The next one, that time frame is too short. So, time frame is, there's always a dance. There's always a dance when you're raising money between the time frame and also trying to put pressure on the actual deal itself to get a transaction done. There's always that dance that typically takes place, right? So from my side, I always, and I'll go through this in my strategy as far as how we typically set it up and how we sort of manufacture that. But this will be a common objection that people will actually have. This was a personal one where they told me that I was too much like equity crowdfunding. Now, what's really interesting about this is that I have done my absolute best for the last 5 years to avoid being positioned in the area of equity crowdfunding because number one, we deal with high net worths, and number two, we don't take success fees. We are a platform, we are a publisher and a matchmaker. And this one's always nice. So imagine this in the dating scenario. Imagine if you're using dating applications and the person you're speaking to says, look, thanks so much. I've decided to go with someone else. I've decided to take another partner other than you, right? This was my rejection where they just flat out said they've decided to invest into another company. This is another one that's quite frustrating when at the end of a presentation, they turn around and say, oh, look, here's the business I'm involved in. When obviously you just want to be talking about your capital raise. You don't want to be talking about the other business that they're involved in. This next one is my favorite. Typically gets a laugh from an audience. The same reason someone gets rejected for a vacuum cleaner, I got rejected from the investment side. Why would I invest into you when I can invest at a C level and get a faster uplift? So once again, just highlighting the different stage of investment. Now, just note that these rejections have come after, several hours of conversation. This isn't just, it was an off the hand cuff after 5 minutes. So it's important to note that. This one was interesting. We had a group actually fly out from Singapore to come and meet us after 3 months of discussions. Then when they flew out, they let me know that they were going through a capital raising themselves. And you're just sitting there thinking, well, what was the point of that? And then finally, we don't like gingers. Just joking. All right. So I like to highlight that, as I said, we all go through that experience. We are all going to get rejected. Now, the next thing I like to sort of talk about is what happens when I speak with investors. Now, typically what investors always want from us is they say, Steve, just introduce me to the good deals, right? Now, what's so strange about this is everyone has their version of what is a good deal and what isn't a good deal. And, you know, I find that interesting. So for me, I'm always trying to describe what is, for them, what is good and what is not, right? That's the reason for a marketplace. Next one that always happens is what companies want. When I meet a company and a founder, they always ask me, Steve, can you introduce me to the good investors? And I say, if you can show me what a good investor looks like, that would be really fantastic, right? Because we can do the introduction, but how do you know that they'll be interested in you, right? And this is what I'm talking about, the process side. So this story I like to use because all of us would know Blackbird, the majority of us. If you don't, make sure you read about Blackbird Ventures. Now, what's really interesting about this story is look at the numbers associated with it. Now, when they went to raise this fund, and this was a recent story, by the way, when they went to raise this fund, these guys were already success stories. They had already built and sold businesses, were well known in the tech ecosystem in both Australia and also in the US. Look at what they had to do to get their capital raising across the line, right? So they mentioned they actually started in 2010, right? And it took until 2013 for them to close it. They had over 500 meetings in 22 months. Just think about that. That's almost a meeting a day across 22 months, right? And they raised 29 million from 97 investors. Now, if you break down the maths of this, that means they effectively were successful. With every 5 investors they spoke to, they were able to secure 1. And with every investor they were able to secure an average check size of 300K. Now, this becomes important when you sort of help you understand what actually a high net worth investor is looking to invest into. Now, Katja is another perfect journey. So Katja is he's a Malaysian-based entrepreneur, and his business model is really simple. What he does is he takes businesses successful in Western world, in Western sort of countries, and he overlays it to Asia. Now, what's interesting about them is at this time, and I'm going to use the example of their TV service, iFlix, right? At the time he was raising money for iFlix, iProperty was already a success story. It was listed on the ASX. I believe it had a market cap of over 500 million at that stage. What is interesting is he was rejected 115 times before he successfully raised money. Now, iFlix is the Asian version of Netflix. So you can imagine the sell, right? You can imagine how they would have been selling it. He was rejected 115 times. Just look at these stats so you understand the effort it takes to raising money. And the reason I'm going to highlight this is I'm going to give some examples of what it's like when people reach out to us to talk about this. Someone's noted that they've got a problem of getting scammers posed as legitimate investors and wasting time. Good point, Travis. I'll look at this at the end and I'll cover that at the end, how to actually ask questions to uncover that. So as we're going through it, said you can see that as an example. So what is actual capital raising? Now, of course, you're thinking, well, it's raising money for my business, right? But really what I want to understand or help you understand is from a process side, capital raising is just simply a marketing and sales process. The marketing part is about generating interest. The sales process is obviously converting them into a shareholder. And this is part of the skill in doing it. And my job is that I want you to feel like capital raising is not some sort of mysterious art. It is literally just a sales process. The only difference is the product, is your company. That's the only difference. So I like to give this analogy. Now, we are, if you're on this call, you're a salesperson. If you're a founder, you're a salesperson. Even if you think you're doing tech, even if your strength is on the tech side, effectively you still have to sell, right? We all have to sell in one way, shape or another. Now imagine this. Imagine you have a new business development person starting. And imagine they walk into your office and on day one, you point to a desk and all that desk has on it is a brochure. And then what you say to that salesperson is you go, okay, what I want you to do is I want you to sit down there, read that brochure, get familiar with it and go sell. how do you think they would go? No scripts, no process, no software, no analytics, no understanding of who they're actually speaking to, no context about how to, no context of how to structure a conversation. The reality is they'd probably be quite unsuccessful. And in fact, you could come visit them 3-6 months later and they're probably still struggling to figure out the process. Unfortunately, that's typically what most of us get as far as in terms of capital raising advice. Or we get the specific advice on how to target a VC. Yet when I've showed you, VCs will invest in less than 1 in 100 companies that they actually meet, right? So the reason I like to highlight that is because that gives you an understanding of the importance of getting a process and having a process when you go to raise money. Now, this is one of my favorite slides to actually do, and it's probably better. It doesn't work quite as well as on a webinar, but it definitely, when I can actually see people's faces, it's quite interesting. The problem that we don't know we have, right? And I like to use the example of Blockbuster. Whenever I put up Blockbuster, it's amazing how many people actually smile as soon as I put up that logo. And the reason is because we actually have good memories of Blockbuster. The majority of us would. And, it would have been a Friday, Saturday night, family outing to Blockbuster, or sort of going with friends, choose a video, choose DVD, etc. Back we come. And there's always one person that had a late fine that they will complain about. But the reality is 2004, Blockbuster had 85,000 staff, right? By 2010, they were bankrupt. And in fact, they've only got 1 store remaining. The reason I highlight this is because all markets move towards solutions which provide efficiency or move towards efficiency. Now, the reason the reason I highlight this is because if you are not efficient with your capital raising process, investors move on. The biggest frustration for investors is time it takes for them to get information, time it takes for you to potentially answer their questions, and the effort they have to go to, the time distance between the time they start the conversation and the time to a transaction, right? That is some of the biggest frustrations that we face in dealing with investors, and also that they're not dealing with any sort of streamlined process, right? Really, really important to know. Now, I'm not going to spend too much time on this, but the typical costs of raising money are sort of outlined here, right? You can obviously spend less than this, but I just wanted to give you a bit of a high level. The area that I actually really want to focus on is how much time you typically spend in a capital raising, just so you've got context and awareness. Now, one of the hardest things is we as founders, we typically don't value our time that strongly. Now, if you think about your time from the perspective of, if you're looking to add $2 million of value to your business in the next 12 months, your value is $640 an hour. And that's on the assumption that you're working a 60-hour week, right? The reason I highlight that is because the time it takes to prepare your documentation, that has a cost. The time it takes to actually speak with investors, that actually has a cost, right? So if you think it's just going to be one conversation and done, it's typically, if you don't have the right process, that's typically not what you're going to experience. Sometimes you'll have to meet with the investor 5-6 times. In my process with Investec, that was actually an 11-month process, right? Partially it was our fault. Also, they were new to investing into venture companies in Australia at that time. So it was just part of them sort of learning their own processes. But if you can understand straight off the bat that ultimately you speaking to 50 to 100 investors over the next year, that will cost you 2 to 4 weeks of your time. That's important to know, right? And then also the last cost I want you to be aware of is that there's a revenue impact and there's also an opportunity cost. For me, when I looked at, so we did some raising early last year, and I didn't quite have my processes down packed like I'll show you shortly. I found out from our side that it had an impact of our revenue of about 80K because of process, because it had to take me and one of my team members out to deal with the interest that we had, right? That's important to know. There's a revenue impact and there's a strategic impact. There's an opportunity cost in raising money. Right, so there's a rough average cost of what it would be for raising money if you're including the time factor as well. And I think that's really important. Now, most of us will just absorb this, but as I said, just understand that cost is there. And also there's ways to improve that. Now, I'm not going to spend too much time on this, but except to say, inefficiency when raising money is one of the biggest enemies. And your actual cost, these are all all this sort of stuff in not getting a capital raising process right. This is the downside. Of course, we all focus on the upside, right? Which I will get to, but you've got to be aware of this is the potential downside of not getting your process right, which is why I'm quite detailed in this presentation. And then the other part is the actual personal cost. Now, when I put this up, some business owners, some founders will say, oh yeah, that's all normal for us, right? But it's all real. We've all seen this sort of stuff. We know people that have actually had this impact from their business or even going through a capital raising, right? I do not say this stuff lightly. You know, for me, said the personal cost, said when I was, you know, earlier on with WI, you know, I put across a 2-year period, I put on 35 kilos, right? So the health impact is absolutely real. And you hear about it all the time, people losing relationships. So there's a significant personal cost in not getting this process right. Okay, so Dunning-Kruger effect. I like to highlight this because typically this is our scenario. Someone will call into our office and they'll say, look, I'm looking to raise money, right? We're looking to raise, you know, $2 million, for example. We've got a $10 million valuation. Sometimes they have revenue, sometimes they don't. And what's really important for us is we only want to get that money from a few investors. In fact, we want to make sure the minimum amount of money that people put in, you know, is 500K. Someone just said that they love my detail. Thanks for that, William. Appreciate. You know, and I find that interesting because as soon as someone says that to me, I know that they typically haven't been through this experience before, or they're just feeling over ambitious at that time, right? So the Dunning-Kruger effect, I think, is really important because this is the reality of what happens when people start out and going through their first capital raise is they think they're amazing at it, but they actually don't know why. You know, there's actually got no competence or no context behind it whatsoever. And then as they start to get more competent, start to experience it more, you start to feel where I would love you to start is here. This feeling of that you know nothing. And the reason being is because the only way that you can actually get good at raising money and move it from that mysterious dark art to well-worn process is through constant repetition, right? And through actually going through the process. And I think that's really, really important. Now, the other reality is sort of leading on from the Dunning-Kruger effect is the expectation of raising, when people start out raising money, is that their experience is going to be like this. I have got such an amazing business that investors should just be willing to give me money. Like, how is it that they cannot give me money? Look how amazing my business is. That's the expectation. The reality is somewhat different. And this is what it can actually feel like. Now, of course, you're always going to hear about that. You're going to hear about stories. You know, where I'll give you my favorite example. One of our shareholders, you know, I saw a media announcement that they'd raised $5 million in a week. I rang him up and I said, look, that's just, you know, I said, congrats on the raise. I said, that's amazing. How did you do that? How did you raise $5 million in a week? He said, easy. I just spent 12 months on it. And I just cracked up laughing, right? Because what was reported in the media was very different to what the reality was. You know, so understand that what you see in media is literally often 12, 18, 24 months behind the scenes work. Read the article. They will highlight how long that they've been in communication for, right? Really, really important. We just had Booktopia recently announced that they raised $20 million from an introduction that they met at one of our events, right? And they said they met him at one of the functions. What was interesting about that was they announced it just, I think 2 weeks ago, last week, 2 weeks ago. The emergence event that we hosted was 12 months ago, but they'd actually started raising, right, back in 2018, right? And their challenges were well known. But just understand how long that takes and how hard they had to work to raise that $20 million. And it also goes to the point of the success attitude. The success attitude really comes from, now all this stuff is fairly obvious to you, but I can assure you when I deal with companies on the coalface, you know, typically companies, when they get frustrated, they either berate or the other one is they befriend, right? In this case with Tony, said he was great in that he understands this one fact. In this area of raising money, one contact can change the trajectory of our business. And that's what we should always be going for. We should work our absolute asses off to make that one contact that should make a difference. And we should be consistently doing that, because that is the power of network effect. So, because one person can make that kind of difference. Yeah. Someone just mentioned about, they heard it. They actually started well before that. They actually started as equity crowdfunding. We spoke to them, and then they participated in our emergence event last year. So when he told me that it came from one of our contacts that they'd raised that 20 million, I actually fist bumped because I was so happy for him, right? Because I know the journey they went through in that process. I said, all this stuff is obvious, but I can assure you, I said, look at it now, but this is what you have to be consistently. Even when you're going through that emotional cycle of fear, doubt, and bullshit, this is the success attitude, the persistence and the consistency and the massive action towards it. So now what I'm going to move on to is actually, so I've talked a lot around the sort of structural from the psychology part. Now, I know when I do this, most people are just saying to me, just Steve, just show me how to get access to investors. That's all I need. It's actually not. Everything else I've showed you is massively relevant to this process. Now the core principles is really important. The first part is get ready. With Investec, I wasn't ready at all. You know, I had a half-baked business plan that I needed to do some work on, right? I didn't have an IM at that stage, didn't have a pitch deck or anything like that, right? So I wasn't ready. Fundamentally, I will say to you, even if you think that you're not raising money for 12 months, get ready. You, as founders, we always know just around the corner, there's two things that can always take place. One is an opportunity, the other one is a disaster, right? So being ready is seriously important for both. And obviously we want to take advantage of it. Now get ready, you know, so what does getting ready look like? Have your pitch deck ready, have your deal room and your data room ready. Said, because whether it's a high net worth investor who just wants to look at a pitch deck or a professional investor who wants a complete data room, at least you've got the capability to handle both situations. Second part is, after you get ready, my advice is to you is to stay ready. And the reason being that if you stay ready, right, what it simply means for you is that you are ready for different situations and different opportunities. But also it means you don't have to spend months getting ready every single time, that you're always in motion. The next one would probably be controversial for a VC or maybe even advisor, because they're always trying to compress timeframes into a short time frame, but always be raising. Now, the reason why I highlight always be raising is because you may not always be accepting money into the company, but always be looking for potential investors. I heard the most beautiful line from it was actually it was a private equity insights event, right? Where it was a GP giving advice to other general partners of VC firms saying that, and this is for venture capitalists, right, who are looking to raise money. He goes, there's always got to be two things you're doing. You're either going to be raising capital or raising friends, right? And I thought that was such a good line. So always be raising. And then as a final point, get to a yes or no as fast as possible. A long drawn out 3 month, 6 month no is very, very beep frustrating. Get to a yes or no as fast as possible. And I'll take you through some of the things I do to help me with that. Okay. So now this is where I like to reshape your context of what high net worths and what the investment community is actually looking at. And as you guys probably know, it's actually not really that much information that really highlights and gives context to what investors are looking for. So you can all read what the sectors are, right? And you can also read the investor type, right? You can see that the majority, and as I said to you before, the majority of the investors that are most active is actually the high net worths that are most active in this space. In fact, high net worths and family offices combined, right, is a combined of 81%, right, as far as that are active in this area. So, and that's, you know, to me, 79%. And I think that's really important to know. The next part that I think I really want to highlight is that, so see down this chart here, where you're talking about, oh, I think I can actually draw on this. Hang on a second. No, I can't. If I do, I don't want to do anything within the presentation. See where it says typical first investment? The reason I like to highlight this is because when most people have the concept of a high net worth, they think that naturally they're going to invest $500,000 or more. That's actually not the case. Typically, you can see 78% of investors for a first investment into a company, I mean into your business, for the first time they're making the investment into you, they will typically invest between 0 to 250K, right? Note that, because that's really, really important, right? Because when that company comes to us and says that, look, we want to raise money, we want $5 million or whatever it is, but we want minimum check size of $500,000. I am just highlighting to you that you are literally knocking out 89% of the potential investors that can invest into your company if you are targeting that amount, right? So I think that's really important to note. The second one is the investment capacity after the initial investment. Look at this. At the 1 to 5 million mark, you can see a significant increase that it goes from 5%, right? Sorry, 4% to 14%. So what I like to highlight, typically what happens is when founders receive a 25K, 50K, or 100K check from an investor, they typically are disappointed sometimes, right? Because they're expecting a 500K. My feedback to you is treat that as keep me interested money, right? So they're saying, I like what you're doing. I'm going to put some money in behind it, right? However, I want you to achieve your milestones. And if you achieve your milestones, we will put some more money in. So someone's asking, can I make the slide large? Obviously I can't do that right now. And also I've got a shortened version of the presentation, which I'll make available offline to assist. Said we want this to be templates for people. Okay, so I hope that helps. And this one's specific to our database where I actually show you the audience in our platform, right? So you can see that we've got 19% of our database in Asia. But I hope that info about the quantum of money is really important. Another tip I'll give you is that if you're dealing with private investors, they typically have an amount in mind that they like to invest. So when you're negotiating with them, you can say things like, say, mate, appreciate, love to understand what types of other companies you've invested into, and also typically how much you invest into companies. And they'll say, 25K, 50K, 100K, 250K, etc. At least at least you've got an idea. If they're more professional investors, they're looking at a quantum. Now, this is my saying. I should do the BS tagline of this and make this my quote, but I just like to highlight this because we'll all say it, oh, that investor was a tire kicker. He was this, he was that, whatever. She was this, she was that. One person's tire kicker is another person's shareholder. And it's always important to remind yourself, if you are getting rejected and you are telling yourself someone's a tire kicker, just own it. Own the rejection. Move on. They're not for you. They're not suited to you. They don't like what you're doing, whatever it may be. It's all good, right? But just know they're a shareholder in someone else's company. Okay, so now we're actually going to go through the 7 steps. Okay, so we've spent a lot of time going through the different parts and appreciate the feedback so far. I like to be as detailed as possible, which people are surprised about. And also I like to, as you say, I'm not talking about raising money from VCs because a lot of people cover that. I'm just talking about raising money from high net worth and family offices and potentially corporates as well. Okay, so I'm going to go through these different areas. Okay, so these are going to be the first 4 areas I'm going to go through. So let's get straight into it. Okay, so this is how I've got my data room set up. Now, I've set this up in CRIISP, which is our platform. So CRIISP stands for Capital Raising Intelligent Investment Secondary Platform. I've got 3 rooms set up. One is a due diligence room, right? And I'll show you what that looks like. Another one is financials with the last 3 years worth of financials. Right, and then I've got this main room, this wholesale investor one. That's my main room. The reason I use that is that's typically got a pitch deck and just some other documentation in it as well. Right, so that's the main room that I use. Now, what does that look like? So this is my DD room. As you can see, I've got information that typically people want to see when they're actually going through a DD. And yeah, someone's just wrote, this would be a great exercise before doing the fun. Yeah, absolutely. So DD, I recommend everyone do this now, right? It's a pain in the ass, but I put it this way, as founders, we all hate admin, right? Let's be honest and admit it. But this, once you get it set up, it's just so much easier to update. You can see the stuff that I've got updated in here, past raise information, legal stuff, HR stuff, blah, blah, blah. It's all relevant. It's all there. I've made it as simple as possible. And when you see an investor go through, you'll be able to see what information I can actually see. The next room is my pitch deck room. Now this, as you can see, this one's got 3 items in it. I've actually updated this since I've got a couple more items in there. And the way I typically approach this is I actually learned this from Atlassian in the Atlassian COO in a podcast. When I get asked a question from an investor, I treat that as a glitch in my software or in my process. So for example, in my deal room now, that survey I just showed you about investors, how that survey come about was because I kept on having investors ask me, what does our investor database look like? So I literally just did a survey and then said, there you go, here's what it looks like. Then I had questions around, okay, what's the traction of our new platform? So then in goes 3 slides, here's the traction of our platform, done. Do you know what I mean? Like for me, I just want to remove all the questions that someone has the potential to ask before they actually ask it. I know how busy I am. I know how busy you are. We can set up the right process to make everything simple for ourselves. Now, you can see my frequently asked question management. Now, I've set this up, and I'll show you how I use this in a second, but I've set this up as a way to answer all the questions an investor is likely to ask before they even ask it. Right? You can see the structure of these questions is it really starts off around the valuation side, right? On the valuation side, you can see there's 2 questions related to that. Are there any references? How to explain the valuation? And this one's about business model. What's interesting for me is that questions that I thought were going to be most prominent for investors actually sits at the bottom, right? But you get the idea that, and I learned this from an investment banker. This is when they do roadshows, they do this. When you are going through the cap raising process, note the questions you commonly get asked, create a standard answer for those questions, and then supply those to investors ahead of time. It will save you so much time in your capital raising process. Here's my invitation. I had a tipping point a few months ago when I saw one of our clients, I did an introduction to them to a big fund, and their first email that they sent to them was actually 3 pages long, and it had 5 different documents attached to it. And that actually really frustrated me. So what I did then was I basically, sent that, we created a template for them to use. So it made it really quite simple and straightforward, right? As you can see, very, very simple, straightforward, and I'm inviting them into my actual deal room. Now, this is the part everyone wants to learn from us, is how do you actually attract investors, right? I just put all this here. Right, these are all the things I said. I will include this in what we actually send around for everyone. But the reality is that building a registration interest list sounds so simple, but yet few people do it. Actually put a list down of all the potential investors that could be relevant to you, put them on a list, right? That's going to be a starting point. But start building this list 6 months from before you start to raise money, right? Board and advisor networks, they have people that are relevant to your actual ecosystem. The one that most people don't think about is actually suppliers and customers. If you guys only saw how many suppliers and how many customers end up becoming shareholders in businesses, you'd be absolutely amazed. For myself, I've got both a supplier and also a customer as a shareholder in my business, or a previous customer as a shareholder, right? All the other stuff, I know I put network of friends in here. I've seen other people do that quite successfully. For myself, I don't target friends as potential investors into my business. And then of course, I'll mention promotional services and conferences are part of it as well. When you're going through the capital raising process, you've got to make yourself as visible as possible. You've got to move yourself from being unknown to known. That's really your job. So that visibility is so important. That's why I love when companies get media. When companies get media, it means that they've got an ability, they're going out to a wider audience, and you can use that for future reference, right? Discussions and presentations. So as I said, actually, I'll give you a word how to think about this. Your job when you're going through this process is to manufacture serendipity. So I use the Booktopia example, right? That was a perfect example of manufactured serendipity, right? When you think about all the activities that they did, right? It was one conversation that made the biggest difference. And that's really what we've got to create. So when you're going through, it's very hard to sell a secret. So going through this process is participate in meetups, go to pitch competitions, look to get media coverage. My tip I'll give you is do not get media coverage unless you are actually raising money. There is no point, right? Don't get it about your launch. Get it about raising, get media coverage when you are actually raising money so you can convert it into potential capital for your business, right? And then obviously the conference and presentation. The goal is that before you actually launch your capital raise is you want to look to have at least 50% of it done. Okay. So that's the first 4 steps. Now we're going to move into the part which I find really exciting, which is the activity part. Now, just so you know, I'm doing my best to answer chats as we're going through this as well. Thanks, Kevin. Appreciate the feedback. So these are my next favorite parts, the activity tracking. I'm sure like all of us, we love stalking activity, right? It's cool to see. So next part, I showed you my frequently asked questions section before. Now I'm highlighting what's really interesting about this is that these are my most clicked on questions. So what our platform does is it basically reorganizes the questions in such a way that the questions which get clicked on the most actually move to the top. So my job is I'm trying to help the investor save time, save money, and improve their efficiency of making a decision. From my side, I'm trying to save time, save money, improve my efficiency of capital raising. You also want to help the investor do this as well, right? When it reorganizes it, what that means is that effectively, I don't have to, I don't have to wonder what's most popular. For example, if I was to ask every single one of you, what is the number one question the investors ask you about your capital raise? You'll give me an answer, but is that actually based in data? How do you actually know? What's even cooler, right, is that when you actually go into the way we've done our dashboard is that effectively you can see you've got your own sort of dashboard as far as activity in the deal room. So every time an investor makes an activity, so let's say you're inviting investors into your room, every time they do something, it gets scored, right? So that way, the idea is that we want to get to a stage where we know when there's likely to be a successful outcome before there is one. Right. But what's really interesting for me is my two out of 3 of my most active investors are now shareholders, right? Sometimes I've had shareholders which have looked at 3 documents and then become a shareholder, right? It's always different, but at least it's interesting to know. But where I use it the most is actually, I invite an investor into my deal room and I set up a discussion with them. Before I have my discussion, I actually see them going to town on my frequently asked questions. So before I have the discussion, I know exactly what is of interest to them before I have that conversation, right? So if you think about this, when you go into most conversations about capital raising, you actually don't know what's in the mind of the person you're dealing with beforehand. You may have read their profile, you may have looked at them a bit, but you actually don't really know what they're thinking. For me, I know exactly what they're thinking. I know exactly what they've looked at inside my deal room, what documents they've downloaded, etc. Right? And this is where you want to get to as you're going through your process, because it, once again, saves you time, saves you money, improves your efficiency. For this one specifically, I noted this one is are there benefits of being a shareholder? That's a very unique question for a potential investor looking at us as a business. So when you're creating momentum, all this is pretty self-explanatory. Typically, we encourage companies to open their capital raise for 60 to 90 days. And in that time, you've obviously got to be building up interest beforehand. You launch your raise, you're doing one-on-one meetings, you're hosting a webinar, you could be doing boardroom sessions, or you could be participating in conference within that sort of 60-day period or 90-day period. Sometimes what we encourage companies when they participate in our conferences is they do it before they actually launch their raise, so they can build interest for sort of 30 to 45 days, then they launch, and then obviously away they go. And then whilst you're doing your raise, look to provide progress updates to potential investors so that they're aware with how you're actually going, right? And if you can do this, then all it's about job is just keep on maintaining contact, keep on driving interest to your room. And once again, it's a sales and marketing process. Here's some examples of my communications. Now, notice how simple and straightforward it is. And as I said, I'm being quite detailed in what I'm actually showing you. I want to show you the one at the bottom, right? This is very specific. I found that what happens is if I share my room with an investor before I schedule a time, typically a conversation never takes place, right? So what I do is I now set it up where you can see this one, I can say, I would like to arrange a brief. That word brief is very important so that they know that you're not going to talk their ear off for 3 hours, right? Introductory phone call to discuss the opportunity. Let me know a time that suits this week or early next, and I'll provide you access to the data room. right? Now, why that's really important is because if they give me a time, I give them access to my room. If they don't give me a time, I don't give them access to my room. As I said, I found that if I give an access to my room before I schedule a time, they typically either one, not go into the room, or two, go into the room and not have a follow-up discussion with me, right? It's just a part of just consistently refining your own process. And so we're all learning. The reason I'm actually doing this is because who else is actually sharing this information, right? So that's why I thought if I can provide as much detailed information as possible that helps companies, we can all start to commoditize the capital raising process. Okay, very simple on the communication side. Try and communicate 4 times a year, so once a quarter. Or if you're pretty proactive and you're sort of dealing with a lot more investors, then you may want to communicate monthly what's happening. This is the humbling realization. Basically, the way I think about capital raise, you need to give yourself KPIs. So your KPI should be get 10 to 40 investors into your deal room and expect that that's what you need to do before you get one investor, right? Do not expect that your first investor you speak to is going to be the one. It is a numbers game like everything else. Do your qualifying, ask questions, find out who they are, all that sort of stuff. Do that, but understand it is a numbers game. Okay, so I'm going to go through this really quickly, but because we're sort of, obviously I've spent a bit of time on it, but this is for me, these are the types of questions that you should be asking yourself as you go through a raise. Be analytical on yourself. Know what your numbers are. For example, if you've spoken to 50 investors and you've converted 5, fantastic. You've got a 1 in 10 conversion rate. If you've spoken to 50 investors and not one has become a shareholder, you've got an issue. You've got an issue with your process. You've got an issue potentially with your valuation. You've got an issue with your structure. There's something there that you're not aware about, right? That's basically not. So when for example, now that we've got this data, if companies come to me and say, oh, look, we haven't been able to raise money, and I look and they've got 50 people in their investor room, I know it's a them problem, not an investor problem, right? So that's a really important part. Process is absolutely everything. The question I also like to ask yourself is, how would you actually score yourself on a scale of 1 to 10 for your skill set in raising money, right? 1 being absolutely horrible and 10 being absolutely amazing, right? Score yourself just so you know where you are, so that you know that, this is an area that you want to actually improve on, right? So for me, I like to highlight this sort of stuff in the sense, I want you to get thinking about refinement and improvement. So as you're going through this process, I want you to understand what the difference could actually be. And I'll skip through all this sort of stuff because I just want to get to the example, right? So where I want you thinking is that if you raised $1 million or $2 million last year, right, and you spoke to 100 investors to raise that, what I want you thinking about is how you can improve your efficiency by 50%. Because if you can just improve your efficiency by 50%, then you'll actually raise another 500K. If you do everything else that I've mentioned before, if you can save, if you can save 2 weeks of your year because you've improved your efficiency, you've got frequently asked questions, you're not answering the exact same question over and over and over every time, it makes a massive difference in the time that you lose in the actual raising process, right? So I always ask people, is it worth 500K being analytical of your process? Absolutely it is. Because do you know why? It's going to save you 6 months worth of time. It could even be 12 months, but whatever it is, that time you save is time you could spend building your business, growing, investing in technology, building your team, whatever it may be. That's the real outcome that we're going for when we're sort of highlighting this education process, is just to give you a different way of thinking, right? So, and then the final question this is what every company comes to me and says, I just need to speak to the good investors. We all have this belief that a good investor is one that invests into us. Trust me, there's plenty of good investors that aren't investing into you or me, right? Because of whatever reason, right? Really, we've just got to keep on speaking to investors, keep qualifying, keep making ourselves visible, right? And just follow our own processes. So now I'm just going to finish off on the investor psychological process. Now we may go like three or 5 minutes over, so just be aware of that. The investor psychological process is really important because the first part is loss aversion. Now, when an investor is looking at your opportunity, they're looking at all the different ways that they can lose, right? The different ways they can lose are 1, money, right? 2, time, right? The time they invest into looking at you, following your updates, etc. 3, credibility. If they tell their networks about it, or if there's media coverage about their investment in you. The last one is actually the biggest one you're competing with, is opportunity cost, right? What else they could have invested their money into is actually your biggest competition, right? Then once you got through loss aversion, then they don't want to be the first one in, and they don't want to miss out. You'll notice typically when you start a capital raise, the first question investors are asking you is, okay, well, who else has gone in? Who else is investing into this, right? Then after you move through that, then it's about bandwagon effect. You'll notice in every media article about successful capital raises, it's typically after there's one lead investor and then there's a whole bunch of follow-on investors, right? That is the best sign of a bandwagon effect. And then after bandwagon effect, it's fear of missing out. So once a lead investor has gone in and then other investors are joining, then investors are worried about missing out on a potential allocation. Very, very typical cycle. And when people are thinking about what are the returns early stage investors want to experience, typically they're looking at your valuation and asking themselves, how can I get a 5 times to 10 times uplift? And then for the companies that are a little bit down the track, so they could have experienced good growth, an impending uplift or an exit is another motivational factor for a potential investor. So this is why pre-IPO opportunities are so interesting for potential investors. All right. So common mistakes, I'll go through these fairly quickly. I've touched on most of them so far, right? But these are all the common things that we see. The biggest one I'm going to mention is the bottom one. When you are reliant on one potential investor with no time pressure, that is really difficult because you've got no competitive tension at the table. In fact, the other big mistake we see is people are just trying to time their capital raising. I can assure you there is no timing your capital raising, right? You can try and time sector, you can try and time all that sort of stuff, but effectively you have just got to continuously be raising. As I said, trying to time it is BS and it makes it too hard on you because how are you ever going to time it? How do you know the right moment that your sector is on, that your business is right, that your perfect milestone is achieved? Because investors will have different milestones that they think is important, right? What one investor thinks is an important milestone is different for another investor. Everyone's going to give you different opinions, right? So that's always important to note as well. With life science and resources, it's slightly different because they do actually have really well-defined milestones for certain things. When we're tech companies and we're, other types, it can be difficult. So these are my lessons, right? I'm always about analyze, refine, improve, repeat. I'm always trying to improve my education, improve my use of software in the process. And also I'm always trying to get access to more investors as part of it. Said you can never have too many investors that you're having a conversation with. In fact, that's one of the best problems that you would actually want to have. Now it's going to give a quick, this is ultimately what all our goal is. Our ultimate goal is that we want to have more confidence when we're actually raising money, right? So that when we go into the process, that we've got confidence in how we're setting up our structure, what our process is, and the outcome that will actually come from that process. But otherwise, most people said, you're flying blind. And I said, if I look at myself, if I understand myself, that's exactly what was actually happening. All right, so utilizing CRIISP, I'll just go through this really quickly, but this is obviously why we built the platform, right? We built the platform because I was frustrated that when I looked at others, I realized the entire ecosystem was fragmented, and I realized that basically no one was thinking about how to build a platform that was very specific for the capital raising process and that how it could allow companies to help commoditize that. So effectively, my belief is that through software, you can take, you don't need to be an investment banker or a corporate finance specialist to raise money. All of us can actually do our own capital raises if you have the right process and the right software. So that's the way we've sort of thought about it. And then the way we've actually thought about our pricing, we do have basically for every company, you can actually go in and set up a free room on CRIISP, as you would have seen. I actually recommend everyone to set up the free deal room first. You can put in 5 documents into it. You can actually use the Q&A process, and also you can see some of the analytics when people are downloading docs and so forth, right? That's all useful to use. We do have a bunch of sort of tutorial videos and so forth, but really what we want to provide people with our software is not just access to the software, but also the tutorial videos, the templates, and also our customer success program, which has really just got a whole bunch of different material for people for the raising part. So first, these are some of the features that we've got coming. The first step is I just recommend for everyone, just set up a free deal room, get comfortable with using the software. If you want to do some additional stuff, we're happy to guide you through the process. We will be sending out an email following this. This is another thing I would like to mention. We do have our biggest event of the year coming up at the end of this month with Emergence. So we'll have 2,000 plus investors and attendees, 40 plus world-class speakers. There's a whole bunch of deal making, whole bunch of networking. We've got David Koch as a guest speaker, Mark Boris as a speaker. So it's actually, you know, it's a pretty big event. It's probably the largest event in Australasia for the emerging company space. Feel free to add me on LinkedIn. I'm always trying to post sort of useful content on LinkedIn that can help in some way, shape or form. Happy now to take Q&A. I'm not sure if Damon's on to do Q&A, but I'm happy to, if you want to just ask questions in the chat, go for it. Oh, you are, Damon, you there?
Yep, I am. Great presentation, thanks.
Thank you. Same with you, mate. Really enjoyed your presentation. It's actually a perfect compliment from technical to process. So guys, feel free to ask questions. Both myself and Damon are here. Thank you for the nice compliments. Go for it, William. I don't know if I'm missing your question. I can just see you've got a question, but I can't see any questions that you're asking unless you're still typing. Ah, okay. Sure, Robert, I'll send you a message after this webinar, but I basically had the slide up there beforehand, just as far as the cost for CRIISP for a year. Effectively, we price it, so I'll go the corny method of 2 cups of coffee a day altogether, but basically it's $2,388 per year for the use of CRIISP. If you want to do other promotional activities, I can introduce you one of my team to chat about that. Travis, in regards to scammers, it's just really qualification, right? So for me, I take the approach, I've got 2 things I do. Firstly, I want to qualify people. So when I have people come in to request access to my room, I ask them if they represent an investment group or they're on behalf of themselves. If they're on behalf of themselves, what is that question from someone? That is ridiculous. I ask them typically, Keno, I'll get to you in a second. I'm not sure why you've gone all out on your equal sign. Yeah, typically I've just questioned them. I'd look to see on LinkedIn. If I'm not comfortable with answers that they provide me, then I typically don't provide them access. I'm cognizant that if I'm speaking to investors in Asia, sometimes wealthy investors do not have profiles on LinkedIn, so you have to navigate that. If someone's if someone's offering guarantees, or looks a bit spammy in their approach, if they're using a Hotmail address, I typically won't reply. If they're guaranteeing any returns or saying that they guarantee they'll get you X amount of money and so forth, I typically avoid it at all costs. So typically there's just certain red flags that I'll use as part of that. If they've got a company website and it doesn't have any profile pics on it, I typically am concerned. And yeah, I would say they're the main ones. I would say most of my, oh shit, sorry. Yeah, it's sort of different areas. Keno, there's absolutely no guarantees in the private capital space at all. If anyone offers you any guarantees on anything, then that's really difficult, right? As far as speaking to investors, right, then obviously that's the actual job. You know, we've been doing that now for 11 years, but as far as whether you will raise money, there is absolutely no guarantees in this space, right? The job of the platforms do not raise money. The job of a platform is to basically save time, save money, and improve efficiency. And has anyone got a legal question? I'm happy to answer the WI. I'm happy to answer the WI stuff afterwards. Does anyone have a legal question for Damon? So just to highlight again, does anyone have a legal question for Damon? Go for it, Damon. I'll let you answer that one.
Well, that's a pretty open-ended question, really. The reason is it's going to solely depend on how much you're raising, what you're raising at in terms of valuation.
Also, the type of company, the sector you're in, etc.
Yeah, but I think at the end of the day, normally companies are giving around 10 to 20% in the very, very first raise. It's with friends and family, and it might be maybe around 5 to 10%. And then after that, normally the next raise is another 10. So that before you raise some real money, you've already given away around 20% of your business.
Okay.
In terms of an AFSL license, the only one that needs to have an AFSL is somebody who is actually going out and sourcing investors who you don't know, right? They're actually going out and dealing in a financial product or a financial service.
Yeah.
And your shares in your company is a financial product. And therefore, you as a company, you are not allowed to go and advertise in the public the offering of your shares. That's against the law.
Yes.
You're not allowed to make a public offering. But there is a section of the Corporations Act, which is section 708.
And also the class order 02273, which is what we operate under.
Yeah. And essentially, you are allowed to raise money from up to 20 investors per year, up to $2 million, essentially on your own with friends and family and people that are connected to you, who are moms and dads that are not sophisticated or professional investors. But if you were raising money from sophisticated and professional investors, like wholesale investor,
or international,
then those limitations don't apply. They just you just can't be advertising in the public.
Correct. So for example, you can't take an ad in the AFR and say, I'm raising $1 million from investors for XX and have your logo on it.
That's right. You can't be on your Facebook page, or well, maybe Facebook. And that would be interesting.
Yeah, no, you can't on Facebook either.
Well, it's Facebook. If it's a group, maybe. But yeah, you can't be going out to the public, and that's something a lot of people are doing, and you got to be very, very careful of that. Very careful of that.
Yep.
A lot of times people will hire, or wholesale investors, the perfect opportunity because it gives you access to these sophisticated investors. It is, it's the most difficult part is to find these wholesale investors. They're the sophisticated ones. They're the ones that everybody wants. They're the ones that have all the money. And they're the ones that are actually looking for startups to invest because they want to be diversified. The property, the banks, there's not much return at the moment. So they're looking to these higher risk, better returns. And a lot of them have a good portion of their portfolio in startups. And there's been some good returns recently in terms of startups. So wholesale investor is the perfect one. If you're not going to hire a capital raising company who is going to lead your capital raise, who has a AFSL.
Yeah.
And those capital raising companies, they also normally take 5% shares in your company and 5% of the money they raise. Whereas in America, they only will take 2%. I'm not American, by the way, but there you go. Social media, in terms of social media, you got to be very careful. Have a read of section 708, just Google it and have a read of it because it's not that complicated, that section of the act. It's long, but it talks about related parties and how they can be related to you and how they've been known whether they've been introduced to you by somebody, you can take money from them. But the main thing is making a public offering. That's what the definition of the section is. That's what you cannot be doing.
So someone just noted that they can't see the question. So look, we'll do our best to read out the questions as well that you're asking.
The original question was, do you need an AFSL
Yes.
capital on your own?
Yep.
And there's exclusions where you can raise capital on your own from friends and family, people that you know.
And I said, I'll just highlight specifically for us. So we work under the class order 02273. Our technical definition is as a publisher, as a matchmaker. The way we've specifically set up CRIISP is more as basically as an administrative tool, and every investor signs off on the class order 02273. And no, Dave, you definitely cannot advertise in the AFR. You cannot cold call, the pitching indiscriminately is sort of a bit awkward now, given all the different sort of meetup events and so forth. But there's a whole bunch of stuff that we do. When we run our events, for example, we have class order warnings on our event registration. We have them at the front door. We have it as our registration process on our website. Look, it seems that a lot of people skirt this now instead of going to gray area, but just I recommend be very diligent in your own processes.
It's a strict liability. So
yeah,
there's a personal response. So if you end up taking money from someone in breach of the rules, it's a strict liability whereby the company and the director will be personally liable for that.
Correct.
You gotta be very careful.
Okay, any more legal specific questions? All the best with your call, Kevin. So Robert's mentioned the question about that CRIISP can actually help with referrals. Yeah, I said, look, we're just trying to streamline the process from a cap raising side. We want the companies we work with, we want them to be looking to access basically we want them to be looking to work with high net worth investors, which is ideal. And from there, it's really just a process. Keno, you've asked what's the maximum a company has raised through CRIISP. Really, I say we've had variations of what companies have raised. Typically, we've seen investment sizes of, and this is from high net worth, of as low as 25,000 to as high as 5 million. I mentioned the deal with Booktopia where there was 20 million. We've had another client, just a general wholesale investor client, that has raised 30 million. But really, it actually makes no difference for you personally. What someone else has raised has got no relevance to what you could specifically raise for your business. And once again, platforms do not raise money. Companies raise money. All a platform's job is to do is to actually facilitate a process. And for me, I proved that with myself. Basically, I was the first user of CRIISP, and obviously I raised money. I raised money for WI and CRIISP off the platform. But once again, platforms don't raise money. It's just guide to facilitate the process. Any other legal questions? All right, I think we're all quiet on the. I'm just trying to see if we've not answered.
Thank you, Steve, very much for letting me join in today. Thank you for everybody for attending. And if anyone has any questions, they can contact me directly.
Perfect. And also, I want to say thank you to you. I really enjoyed your session, and also a big thank you to the LawPath staff. Said really good working with the team in organizing this. Love the work you're doing. Congrats to to you guys, to the LawPath team in their recent capital raise. It was beautiful to see that as an announcement.
Yeah, it was. And I just recorded 25 videos yesterday too that we're about to start launching.
Fantastic.
Yeah, so that'll be fun.
Good to see not camera shy. 25 videos in a day is fairly good.
I changed my jacket and my tie several times. So if anyone watches them, don't let anyone know.
Oh,
But,
perfect.
yeah, no, it was fun. And
All right.
yeah, all right.
All right. Well, let's finish up here. Thank you very much, everyone, for coming on. Really appreciate it. Obviously, please, we're going to send out a follow-up email. If you can reply with either testimonials or feedback or anything like that, that'd be fantastic. We obviously want to do more of these and promote it to more founders so that they can get sort of access to this information as well. Thank you very much, everyone.